Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project Podcast. I'm your host, Steve Fieros with Tri-City Equity Group. Today we have Calvin Roberts on the show. Pretty excited to have Calvin on the show today. He's got an early start going into his career. We're going to dive into some hot topics on insurance and how that can affect your business and operations and kind of the current state of the industry. So, and Calvin's nationally licensed insurance commercial broker, principal of Falcon Insurance Agency out in Michigan. He's in Ann Arbor. It's a boutique insurance brokerage specializing in multifamily, commercial, mergers and acquisitions, pre-acquisition insurance guidance, which I think is actually pretty cool. Being able to take a look over insurance policies and give some additional guidance just through experience. I think that's huge. Calvin's been active in the field since he was 19 years old, which is amazing. We were just talking a little bit about that off camera. And just having that additional experience, such a young age and a different perspective, I think that's great. So Calvin, excited to have you on the show. Welcome.
Thank you very much. I appreciate the opportunity to speak with you.
Yeah, absolutely. For those of our audience that might not be familiar with you, kind of what you've got going on, how did you get started? How did you get started at 19 in the wonderful world of insurance? I know that it's I hear a lot of young real estate investors, but I don't hear too many specifically going on to the risk management side or insurance side. So yeah, give us a little bit of your history and your background.
So I began in the field at age 19, and really it came down to myself having done a fair amount of research into various career opportunities that presented enormous opportunity for developing considerable financial ability as quickly as possible. I didn't want to, not be where I want to be for 20 years and just wanted to try to go out there and go get it as quickly as I could. I began at an Allstate office in 2016 and was quickly promoted to the agency sales manager role after about 8 months. So here I am, 20 years old. I mean, I look young today, but I was effectively a child at that time with, 10 staff. I was managing 7 agents and 3 service people, and they were all twice my age. And it was like being thrown into the deep end of the ocean at that time, which, despite being a high stress experience, it was a great leap forward in terms of, career destination and getting to the point where I wanted to be, where I am now, kind of thing. I remained at that office for a total of 2 years, and then very quickly determined that I needed to be an independent broker. I felt that my hands were tied by only having access to Allstate, one company. I was great at forming the client relationships and explaining the product and overall doing my duties. But, it's like being a builder and only having access to a nail gun. Sometimes you need the hammer, sometimes you need the Sawzall, and really having all of the tools in my toolkit was one of my biggest priorities at that time. So then from 2018 to 2020, I worked at an independent brokerage in Ann Arbor, Michigan. Got my feet wet in the exciting world of independent P&C insurance, everyone's favorite topic. And, it was a great experience as far as learning the independent side of the business, where we don't work for a company, we work for our clients, and overall getting my feet wet in that world. But then just prior to COVID, I was getting to a point where, I needed a compensation plan where I'm able to get paid on my renewal business and not just a salary and then a split on the new business I bring in, because that's really where insurance scales and becomes an attractive prospect. So then right as COVID began, April 2020, I split off from that agency to work under a 1099 relationship with, at that time, one of my most active competitors. We were going head to head on cases pretty much every week, and they took note when I beat them several times, and we worked out a nice relationship on that note. So the biggest incentive there was, one, being able to get paid on my renewal book of business. As clients renew their policy each year, I got my piece of that. And two, it was that I had the understanding in a contractual agreement that if and when I ever split off to, go to greener grass or form my own brokerage, I owned my client relationships. I could take the policies I wrote with me. So it provided a launching pad to really form my own independent brokerage and hit the ground running on day one. So then going into 2022 in January, I had a roughly $1.3 million book of business. So I had enough premium on the books to where when I split off and formed my own brokerage, I had the capacity and existing client relationships to be able to go out and attract companies like Nationwide, Travelers, Liberty Mutual, etc., to give me a contract. So I would have my own access with my own agency. So then earlier this year, we formed Falcon Insurance Agency of Michigan. We're a national boutique commercial insurance brokerage specializing in serving multifamily and commercial real estate investors. We're licensed presently in 32 states and the District of Columbia, and will be licensed in all 50 states by mid-quarter one, 2023, just kind of working through some of the regulatory hurdles to attain that. But we are presently active in all of the major markets where multifamily investors are investing and operating. Unfortunately, we don't have Wyoming yet, but, Texas, the Sun Belt, the upper Midwest, the Pacific Northwest, we're extremely active and competitive in. And really what we bring to the table is, one, we have extremely competitive rates because we have access to all of the insurance companies who predominantly serve the multifamily investor space. I built out my, carrier relationships around being able to serve multifamily investors well. Two, we are extremely available and responsive. I'm available 7 days a week, very close to 24/7, and am pretty much constantly providing an indication to one of my customers because, hey, I'm thinking about making an offer on this building. Where do you think the insurance will land? I'll get them early quote with one of my companies so they have something to plug into their pro forma. Then once they get the deal under contract, I will throw spaghetti at the wall and hit all of the companies who are, active and competitive players within that multifamily space, provide a complete market report so you see where each company is coming in at with their bid. So you're always extremely confident that you're getting the best possible deal. Really, the third thing that we bring to the table is just an innovative approach in terms of managing risk outside of insurance. I believe insurance is a big part of organizational risk management, but it's not the only element in play. And what I mean by that are, suggestions for things that we can add to our tenant lease agreement. Do you expressly disclaim the liability of your tenant's personal property or their vehicle? What if the neighboring property during a windstorm has a tree fall on your parking lot? Happens pretty regularly. And without such a disclaimer in your lease agreement, such a tenant who maybe did not have insurance on their vehicle or did not have coverage for physical damage to the vehicle, and they need this vehicle to get to work, and this presents a, huge problem for them, they may otherwise be motivated to attempt to sue you, perhaps in small claims court, so they get $10,000 for their, clunker that they weren't insuring properly. But by having risk transfer agreements, such as the explicit disclaimer of liability of tenant auto, as an example, we're able to get ahead of such instances and realistically dismotivate 90% of people who might otherwise, be considering bringing suit against you from it ever getting to that stage. What they say, an ounce of prevention is worth a pound of cure. And that's really the approach that I bring to the table.
No, that's awesome. And it's a lot to unpack there. But no, you're absolutely right. I mean, that's whether or not we realize it, let's say as operators or really any owner, like that kind of stuff, right? It's going to impact you one way or the other, right? Like, oh, okay, even if your tenant, your resident is not, let's say, going down the litigious route, well, guess what? If they don't have their car because the tree fell on it, well, how are they going to get to work? Exactly. And now they got a problem paying the rent. Now they got a problem paying the rent. So, it's gonna, like I said, it's you kind of have a domino effect there, and you're almost trying to ward off problems before they ever even get there, right? Anticipate those issues, and obviously, the larger of a property that you're dealing with, the more residents, the more potential headaches, that you could encounter, right? So, yeah, the more that you can do to jump in front of that and kind of like, okay, no, we're going to try and, all right, do some risk management here. Get, okay, this could happen. This could happen. Let's make sure we're well protected. I think that's great. That's great. And you mentioned a little bit earlier too, like, how COVID kind of, and it has for so many of us, right? It's kind of impacted the way that you view your personal business, right? The way that, for us, as multifamily operators and real estate investors, how you view your portfolio, how you're managing vacancy and all these factors that are outside of our control, right? Because there's only so much we can do to kind of mitigate some of that. What are you seeing? How are you able to help people, or what kind of changes have you seen, like let's say in the insurance space, since COVID has happened? Obviously I know we've seen a lot of material cost increases and, that kind of stuff. That all has a trickle down effect, right? Mm-hmm. Like, what are you seeing like in the insurance space now, especially since you've launched your independent brokerage? What kind of changes have you seen in the industry, and, how are you helping clients to kind of navigate through some of that?
So there's been a fair amount of calamity, specifically within the property insurance marketplace over the last 3 years. The first on everyone's mind is how inflation is affecting everything from building materials to the cost of labor, to hire a contractor, to come and remedy damages that happen to our property. That is substantially impacting the expected paid claims for insurance companies, meaning that, let's say you're an insurance company, and for every $1 million in premium that you collect, you're anticipating paying maybe 60 to 70% of that toward claims, and then maybe 25 to 30% on, your expense of administering the insurance company and paying out claims, paying an adjuster to drive to your property to write up the damage scope and just the other ancillary type costs that come with being an insurance company. But because of that inflation and the rapid impact to building materials and the cost of labor, you're actually paying 80% of the money that you collected towards, the physical repair or replacement of the property. That's a substantial increase in the loss volume, meaning that you're likely not posting any underwriting profit, by being the insurance company. So as a result, you have had a couple responses by the industry as a whole. The first would be that, they're restricting the deductibles that we can choose, or they're, otherwise reducing their capacity within that segment. So as an example, Nationwide, they are a very active habitational, multifamily insurer. They do a lot of apartment policies and commercial real estate throughout the United States. As of April of this year, they are no longer entertaining actual cash value loss settlement for their habitational program. It has to be replacement cost. And the reason for that is, they're collecting 50% of the premium with ACV, but paying 75% of the amount that, would be paid in a replacement cost valuation loss. So the math just does not work for them any longer to offer such a product. And two, you're seeing a fair amount of increase coming from the reinsurance side of things. Reinsurance is effectively insurance purchased by an insurance company. Let's say you're State Farm and you want to use your capital responsibly. You don't just want to sit on huge, reserves or pools of money to settle possible expected losses that you think are unlikely to occur. So you purchase reinsurance so that if you experience more than $5 billion in hurricane-related claims in one season, the amount over $5 billion is covered by a reinsurer. So someone like one of the Berkshire Hathaway companies or Zurich Reinsurance or any of the other, like an AIG, large international insurance group, who they have the reserves, they have the capacity to take that on. Well, the cost of reinsurance has spiked significantly over the last 3 years. It's been trending in an upward direction for some time now, just with the way that inflation and the occurrence of large catastrophic claims, Hurricane Ian, the Texas snowpocalypse, the, weather events we're seeing in places like Central California with wildfires. When those events happen, that risk is transferred to the reinsurer, who, when it happens as consistently as it has been over the last 5 to 10 years, eventually has to raise their rate. And as a result, that cost of reinsurance going up is passed on to the end consumer via the cost of their primary insurance, a policy you buy from State Farm, increasing in premium. And really, the third challenge has been in more select marketplaces. Florida is kind of a case example on everyone's mind. Florida is its own special beast when it comes to property insurance because, you have the natural risk of hurricanes and, windstorms and other large catastrophic risk events occurring. But it's also a regulatory environment that is generally hostile to the insurance industry. And, I use the example of a public adjuster. In most other markets, public adjusters are not on anyone's team. They're not on the insured's team. They're not on the insurance company's team. They're just looking out for themselves. And this is also true in Florida by large, but really where companies like public adjusters or roofing companies are contributing to the problem in a market like Florida is that due to the way insurance is regulated in that state, let's say you hire a public adjuster and their job is to maximize the amount of money that's paid out in a claim. That's how they get paid. That's how you get paid. You have aligned interests in that sense. So that roof for your multifamily building that would probably cost $250,000 to completely redo. Well, the public adjuster says, oh, well, we think it's actually going to cost $1 million. And, maybe they have their justifications for attaining such a high replacement cost or something like that. But more often than not, it sure seems to be that they're giving a sky high number in the hopes that this makes it to mediation. And then when you go to mediation, you have a mediator in the middle, you have the insurance company on your left side, and a public adjuster on the right side. And the mediator has really no technical knowledge to be able to ascertain what the actual replacement cost of a roof, for example, might be. Right. So they might propose, okay, well, we'll split the difference between the two. The insurance company is offering $250,000. The public adjuster is asking for $1 million. We're going to say it's $600,000. So then the public adjuster says, great, we agree to that. And if 2 of the 3 parties find resolution, it is immediately binding. And that is what the insurance company must then cut a check for. So it really comes down to when everyone is getting a free roof, nobody is really getting a free roof. We're all paying for it.
No. No, and especially, people like us. I mean, maybe that works out for an individual homeowner, right? Because how often are they, going and trying to get insurance? I mean, again, eventually they're going to pay for it in an increased premium. But like for us as investors who are making multiple purchases, we will be. That's a continual part of, our investment strategy. Like we're the ones that are really also running into that. I mean, it's much more visible to us. So, I mean, how can, let's say an investor how can somebody like me, hey, I buy short-term rentals, I buy, multifamily. Like, what are the things that we can do, or how can we work with, our insurance provider or agent, to help kind of mitigate some of that, or, how can we still get a premium that works for us? Because, you mentioned earlier, hey, somebody reaches out, I'm looking at buying this multifamily property. I want to reach out to you, give me a preliminary quote, so we can plug into our underwriting. What are things, anything that we can do, to help, do the best shopping, or is that something we rely on you for completely, or, what are some solutions there?
So I bring a partnership approach to insurance for multifamily operators, in the sense that by being prudent with your risk management from day one, you are able to get ahead of, a bad claim scenario happening. And within the multifamily space, it's insurance rates after a claim function differently from what you might experience on your home or your auto policy, where, oops, I had an at-fault accident. My company's going to keep me, but they're going to raise my rates 50% for that first year after. With commercial insurance, it's more of a question of eligibility, where if you have a loss performance that is non-desirable, maybe the insurance company's paid out $2 for every $1 they've collected from you in premium, and they're losing money, they'll non-renew us. And then it becomes a game of, who can we find that will entertain us? What kind of a narrative can we sell them in terms of, hey, that was a one-time claim occurrence, and we've done X, Y, and Z to remedy that problem, so this does not happen again in the future. So it becomes more of a negotiation between the insurance broker and the insurance companies that we're soliciting coverage from than you would find on, a single family rental or anything smaller than true commercial insurance, type accounts. So there are a few recommendations that I have for all of my multifamily operator groups. The first is that in your lease agreement, I recommend we have a tenant liability insurance requirement. So renter's insurance, essentially. It's really that liability coverage that we're most concerned about. And we do that for two reasons. One, if the tenant causes a small kitchen fire one night, and maybe it does $80,000 in damage. They get the fire put out, but it's expensive even when a small fire occurs.
Smoke damage or whatever,
Exactly.
There's all kinds of stuff. Yeah.
And we don't want that to turn into a claim on our policy, because we don't want to get dropped by our insurance company who's giving us favorable pricing. So we require that they have renter's insurance so that it turns into a claim on their policy instead, by triggering that liability coverage portion of the policy. And the second reason I recommend this is so that if, let's say we manage 300 doors and we're thinking, I want to push this property a little bit harder. I'd like to generate more revenue from it. I want to increase the NOI so I can get a greater valuation when time comes to sell in 5 years, but I can't raise rent any more than I already have. I've pushed that as far as I can. You offer the tenant liability insurance to your clients, your tenants, so that if you run into a scenario where maybe you're renting to a 24-year-old who they own $5,000 worth of personal property. They don't really care about covering their clothes and their, cheap couch and that kind of thing.
Mm-hmm.
You become the path of least resistance for satisfying the requirement in their tenant lease agreement by offering the tenant liability insurance via a master policy. And your cost might be $750 per door per month. And you in turn charge the tenant $1350 per door per month. Well, that's $6 per month in free cash flow per door that can otherwise, boost revenue generated by your portfolio. So it's another way that you can tap into the insurance sector and make it into a revenue center, a profit generating opportunity rather than solely being a pure expense.
Yeah, nice little arbitrage opportunity. And when you're looking for every little, because that's the thing, right? Like, especially with commercial, everything driving that NOI boosts evaluation. So even something, what seems like insignificant, it's like, well, yeah, but if we've got a, 100, 200 unit complex, it's like, okay, but that's significant.
Oh, yeah.
Especially now, especially in our, current environment, right? Because there's it's pretty volatile in terms of what's happening in the economy and, all that kind of stuff. So yeah, driving rents, specifically in certain markets is becoming a little bit more of a challenge, right? So yeah, no, that's awesome. And this too, I think that just kind of highlights, how important is it for, let's say investors, and you talk to them to have an insurance broker that understands real estate.
It's imperative. There's a lot of insurance brokers out there. There are a much smaller number of insurance brokers who diligently serve the multifamily community. I mean, I can tell you within Michigan specifically, there are probably 4 other brokers that I commonly will go head to head with on a, upper small market, lower mid market account, between maybe 100 and 1,000 doors. There's very few players in this space who can do it very well. There's a lot of insurance brokers where if you call them, they can probably write you a policy for your 16-unit apartment building. However, if you're not quoting multifamily every day consistently and going up against other insurance brokers who are knowledgeable in this space, you're not getting sufficient practice to really perform to the best ability possible. I use the metaphor of, you can enjoy playing basketball and, you might be able to show up to the court after having not touched the ball and shoot a 3-point right away. But realistically, most people are going to improve if they're practicing consistently. So you need someone who, 1, you trust, and 2, is doing sufficient volume within the multifamily space to where they are intimately aware of market happenings and keep their ear to the ground whenever there's a change in the commercial property insurance marketplace.
Oh yeah, absolutely. I mean, it plays such a vital factor into, ongoing operations. I mean, we run into it too. I mean, we're doing, value add on different properties and, so we're having to jump in front of, okay, like renewals and, what we can do. I mean, we're trying to be aggressive in our acquisitions as well. So, I mean, it plays a valuable role in terms of ongoing underwriting and acquisitions and, all that kind of stuff. So yeah, whatever we can do to work with a broker that's knowledgeable, on the investment side, because you're right. Like you can go out and find, most insurance providers will, they'll write you a policy, it's not, but having somebody who understands the investment end of it. Right. And okay, how can we better serve, for one, not only the residents, right? Because, you mentioned earlier, having that policy in place, that's a benefit to them. I mean, that's a win-win. So it doesn't have to be just one-sided, but having somebody who understands that can help implement, a strategy, that serves as a win-win for everyone. That's huge. Yeah,
absolutely. It's, with the tenant liability example, it's one of those things where even if the tenant on day one does not understand the value into, being forced in such a program, if they do not provide their own third-party renters insurance, when they cause a $80,000 kitchen fire, and, instead of being sued by the insurance company who's trying to recover their loss and get some of that money they just paid out in a claim to the property owner back, that liability is protected up to, that $100,000 point, meaning they're more financially stable and secure, even if they don't see the benefit of it immediately.
I know, and it's one of those things too, right? It's like, and of course, it's not anything to demean, residents or anything like that. But it's just like, well, look, we're looking out for your best interest because we can kind of see a little bit of a bigger picture, right? We can step back, look a little bit, further sighted, to understand like potential risks, of course, to our own, property and business, but also for them too. Because, I think we'd all agree. It's like, well, typically most renters are not in a position where they can handle substantial, financial impact, right? So they lose their car, or they have a significant medical whatever. It's like, okay, yeah, having the proper insurance is huge, 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 huge. So no, that's awesome. Yeah, very good. Well, we're kind of at the point of the show where we transition into a little bit more of what we call our fire round. It's a little bit more straightforward, a little rapid fire. So it's something you're game for?
Love it. Let's do it.
All right, right on. Well, what is the best book that you recommend other than, let's say, Rich Dad, Poor Dad? That's kind of the real estate investors, holy grail. Any particular books? It can be whatever. It doesn't have to be specifically real estate related, but just looking for a best book recommendation.
So I have a non-conventional answer to that, and I've always been extremely interested in musician and artist biographies. I take interest in on a personal level. In 2017, I purchased the Gucci Mane autobiography, and I read it in my first session from start to finish. And I think it is the best business development and sales book I have ever read. And I've read quite a few. It's definitely outside the, normal sales book category. But overall, it brought a do-it-yourself ethos to a different business, music and marketing. But most of the same fundamentals apply. If you want something, go out there and hustle for it. And that's really my biggest takeaway from that.
That's awesome. That's a great book recommendation. I love hearing stuff that's not kind of the typical things that we would hear. And it's obviously working for you. I mean, that's something you put in application, and it's kudos to your success. So that's awesome. Shout out to Gucci Mane. That's pretty awesome. You should leave him a review. All right. So next question. What would you consider? What's your superpower?
I would say my strongest single aspect is really the level of diligence and care I bring to every case. I would rather pass on a deal if I knew that writing it a certain way would lead to a negative outcome. I'd rather not win the sale if, from my perspective, I'm pulling a landmine out that we could step on at any point. And that's something, unfortunately, I run into fairly often on the PNC side. And I don't think that other brokers are trying to do anything, malfeasant or otherwise intentionally negative. There's no maliciousness at play. I'll give you an example. I commonly, especially in the Midwest, see properties insured with replacement cost plus settlement that's based around the rebuild value of the property, but they put the policy limit at the purchase price, which in the Midwest markets can be, significantly disjointed. So you have something called the co-insurance clause that comes into play on commercial property insurance. And it's generally 80% of, what the full rebuild value should be. So if your building that you paid $400,000 for would require $1 million to completely rebuild, you could generally insure that for $800,000, 80%. But if we wrote the policy at the purchase price, this example being $400,000, in a claim scenario, they're going to say, okay, well, the amount of insurance you had, $400,000, divided by the minimum, 80% of the rebuild cost, $800,000, equals 0.5. That's your co-insurance multiplier. So that $200,000 fire you just had, we'll cut you a check for 50% of that minus your deductible. I run into this pretty much every week. It's especially in the high inflation environment we've had over the last few years.
Sure.
If you're not carefully monitoring your building limits, make sure that they're within a reasonable range. It's entirely plausible that this would come into play. In fact, probably 70% plus of the policies I'm reviewing have an issue with this. However, because of the level of diligence and care I bring to the table, that has never been an issue for me or any of my clients, because at each successive renewal, rather than just kind of leave it on autopilot and, hey, here's the price kind of approach, I dive into it and make sure that I'm babysitting my building limits, make sure that they're adequate. That way that cannot happen. Because, it's one of those things where your common investor they're not an insurance expert. That's why they come to someone like me for that guidance. And
Right.
if the insurance broker that had been serving them, let's say 80% of their day is writing home and auto insurance policies, but they have maybe one or two big commercial accounts that, they're responsive on, they're friendly, they have a agreeable price because they're writing it with less coverage than they really should be. There are no visible outward issues until the loss happens.
Mm-hmm.
So I bring a level of care to every account I work on where, those are the things that would keep me up at night. So I'm very active and take preventative actions to prevent that scenario from unfolding.
Yeah, no, that's great. And it is a superpower. You're right. Like, most of them are not going to necessarily care about it. So, and that's a great way to make us a differentiator for yourself too, right? Especially as you're launching, you've launched your independent brokerage. It's like, hey, this is, a specialized, service that we offer, that you offer. It's like, well, hey, look, I'm going to look out for your best interests. You're not going to get that somewhere else, especially at some of these bigger carriers, and you're literally just a number. So yeah,
and
that's huge.
The biggest issue that I commonly run into and very commonly fixing. And, until how co-insurance, as an example, is explained to the investor, I would have never been familiar with this until I really dove into multifamily insurance 6 years ago. And I wouldn't expect anyone who does not have a PNC license to be aware of this. So by really bringing that educational element to the table, I often write policies where they're more expensive than they were paying before. But hey, at least you're not going to be paying 70% of the loss out of pocket. You can buy insurance for a acceptable price that it could be more than you were paying right now, but the policy is actually going to perform the way that you expect and demand of it when the loss happens. And that's really the biggest thing I'm concerned about. I'm not a big fan of insurance companies. I'm not on their team. I'm on my client's team. And in doing so, I leave no out for the insurance company to take. Oh, well, you didn't do this, or you should have done this kind of thing. I won't allow it to go that far.
Yeah, no, that's awesome. And that's great too, because like since you're servicing a specific niche within the industry, right? Like, that's valuable because your reputation servicing that particular segment of the client base, right? Like talking about residential and talking about auto and all that kind of stuff. That's huge, right? It's all about your reputation within the industry. So that's great. And you're shedding light on, hopefully, definitely to me, but also, to a bunch of our listeners as well. So, at the end, we'll make sure we'll have your contact information. So, people who have questions about maybe their individual policies, or even just want to pick your brain about Gucci Mane, they can reach out.
I appreciate that.
Next question. What over your career, what's the biggest lesson that you've learned?
Play the long game. That's really the approach I was taught fairly early on, thankfully, and it's stuck with me. You can win an account today by doing it the wrong way, but if it's not properly constructed, it's going to fall through your hands at some point in the future, and you'll suffer the reputational harm in doing so. So I would rather be the slow and steady who wins the race than try to cut corners and shoot myself in the foot.
Yeah, no, that's great. That's great advice. All right. And then for, for the most of our listener base is, again, our podcast is geared towards like busy working professionals. For somebody who's in that mode, busy working professional, and they're trying to work towards financial freedom, what advice would you have for them? Like, as being somebody who's an ancillary service provider, to the industry, obviously you work with a ton of investors. What advice would you have for them? Having this outside perspective potentially.
Set goals and measure for those goals. What you measure is important to you, and you measure it because it's important to you. And if you aren't measuring, you're really hoping, is the way I see it. So if your goal is to retire in 10 years and have a stable amount of cash flow from real estate, providing you, the ability to do so, work backwards from there. Set the target that you would like to be at that point in time, and then establish the steps working backward that are required to get there. Maybe you want $150,000 a year in free cash flow. Okay, well, how many properties do I have to purchase to be able to do that in 10 years? And how many properties do I have to purchase per year to be able to do that? And so on and so forth. Kind of thing.
Right on. Yeah. No, that's definitely great. That's huge goal setting, reverse engineering. Got to know where the ship is going, right? Exactly. You got to have the course. You got to have the course, or else you'll run aground. So yeah, no, that's great advice. Well, like I said, mentioned earlier, I'm sure we're going to have, some of our listener base want to reach out, with insurance questions, or maybe looking for a quote, looking for some guidance. What's the best way they can get in touch with you? Social platforms? Is that just emails? Is that phone numbers? Like, what's their best contact information? We'll make sure we leave it in the show notes for the listeners. But, for those that are listening on audio, what's the best way they can get in touch with you?
So we're extremely responsive to phone, email, Facebook, or LinkedIn messages. I'm essentially glued to, my phone and perks of working with a 26-year-old insurance broker, right? But my clients, they regularly see me responding to an email at 11 a.m. on Sunday morning or 9:30 o'clock on Tuesday night. And I'm available outside of those conventional 9 to 5 hours. And really, if, someone wants to reach out to me, I am extremely receptive to whichever mode of communication is most preferable for them.
All right, awesome. Well, like I said, we'll make sure to put your contact info down in the show notes so they can get in touch with you. Yeah, Calvin, it's been awesome having you on the show, giving us pulling back the curtain a little bit on the insurance industry and things that we should be looking out for, as investors. Looking forward to, again, keeping in touch with you. And like I said, hopefully we have, listeners that reach out to you. If they've got questions, definitely hit up Calvin. He'll be sure to steer you in the right direction. So, but it's been a pleasure having you on the show. Thanks so much for coming on with us today, and have an awesome day.
Likewise, I appreciate the opportunity once again.
Absolutely. Thanks so much. Aloha, Calvin.
Thank you.
Super insightful talk with Calvin as he shared with us some of his insight in the insurance industry, pulling back the curtain a little bit to let us in on some insider knowledge and some things that we can do to help get in front of potential problems on operations for multifamily, but it also holds true for whatever kind of investment that you're doing. We'll definitely have him back on, probably shed a little bit more insight on maybe the residential or short-term rental space as well. Very knowledgeable guy. So make sure that you're reaching out to him. So if you're interested in connecting more with us, Tri-City Equity Group, and the multifamily projects that we've got going on, definitely go check us out at tricityequity.com to learn more, to connect with other, like-minded investors, people who want to get better, maybe learn more on the multifamily space and just investing in general. And you're local to us. And even if you're not local, join our Facebook group, Honolulu Multifamily and More. Definitely share different articles there, the insight. You're able to connect with other like-minded investors. We've got quite a big following over there up to this point. Looking to continue to expand that. If you're local here in Honolulu or Outer Island, we'd love to see you out at one of the in-person meetups. We've definitely started those back up. Nothing better than meeting face to face. So we'd love to meet you in person. So definitely, we try to put those on monthly. So stay tuned, join the Facebook group. You'll be in touch with, all of the meetups that we have going on in person. If you found value, of course, in this podcast, make sure that you're sharing it. Leave a review, leave a 5-star review for us, and make sure that you're sharing it with somebody else that you think that might find this type of content that we're putting out interesting, and people that want to learn more about real estate investing. We're also excited too. This year, we're going to be putting on our second conference. So the annual conference, so the Millionaire Mindset, the Hawaii Millionaire Mindset Conference, this year is going to be over on the Big Island. So definitely want to make plans to be out there. It's going to be during the summertime. So if you're not local to Hawaii, it's a great way to be able to write off, talk to your CPA, not financial advice, of course, but to be able to have a business trip out to Hawaii. So and that portion of the island itself is beautiful. If you're on Oahu, a little bit of a staycation, getting over to another one of the islands. But we're excited to see you come out there. So make sure that you're making plans to be there. But all right, guys, we're going to see we'll call this one a wrap, and we'll see you next time. All right. Aloha.